2020 was the year of the growth stocks, whereas 2021, they've been getting absolutely wrecked. And the face of growth stocks tends to be Cathie Wood, who rose up in 2020 as an investing god, but now in 2021 has been kind of the laughingstock of the market. Granted, her returns since inception of the fund have been solid. The question though, is she outperforming when you adjust for risk? Cathie's main focus for her ARK Invest flagship fund, ARKK, has been always disruptive innovation. And the one name that has performed extremely well for her is Tesla, as it was her highest weighting and continues to be. But you can see based on the list of companies that are in this fund, they all have one thing in common, and that's disruption as well as being innovative. Something though that's not discussed amongst retail investors too often is risk-adjusted returns. That's taking into fact the beta of the stocks that you own and comparing it to the S&P 500. The official definition is a measure of a stock's volatility in relation to the overall market. If you hold high beta stock, for instance, a company like Tesla, who has a beta of 2, this company is expected to move more because it's more volatile. What does this mean exactly? In a bull market, Cathie Wood and her picks are probably going to do extremely well. So in 2020, we saw the market go pretty much straight up, and therefore a lot of her high beta stocks also outperformed. On the flip side though, when growth goes out of flavor and you have interest rates being hiked by the Fed, all of a sudden growth doesn't look as good, and these same stocks that do super well in a bull market get absolutely destroyed in a bear market. With all that said, the returns for this fund are still impressive. You look at 2020 and this thing went from 50 to all the way 137 at the beginning of 2021. If you invested in the fund after 2021 began, that's where you're not loving Cathie right now. So how do we adjust the returns for risk? And there's a couple ways to do it. This article talks about the Sharpe ratio, which takes the annual returns divided by the annualized volatility in order to smooth out those risk-adjusted returns. If you overlay ARK's returns versus something like the NASDAQ and QLD, which is a leveraged NASDAQ product, we see that when you adjust for the Sharpe ratio, that ARK actually underperforms both of these benchmarks. It is important to mention though that ARK did have a higher return versus the NASDAQ. It just took more risk and volatility to get there. The takeaway is we have to adjust for risk in order to understand if a fund manager is actually outperforming or just taking excess risk in a bull market. Because if you used a leverage product like QLD, risk adjusted, you actually would have outperformed ARK. Another article pointed out something interesting I didn't even think about, but the ARK Invest fund had more inflows at the beginning of 2020 as there was outperformance in the fund. That created this cycle of them being able to buy more of the stocks that they owned, and it juiced up a lot of these stocks. As people take money out of the fund, she may be forced to sell these stocks at the same time. When you factor in the money-weighted returns of the ARK Invest ETFs, that's when it's less impressive. If investors continue to pile out of the fund, that may continue pressure onto the stocks that she owns in the portfolio. Damn it, and I own Teladoc. Come on, Cathie. So if you are looking for high growth ETFs as a replacement for her fund or ARK Invest, you could use something like QQQ or QLD. I still think Cathie is smart, but she is getting the ridicule because she took the glory in 2020. But it makes sense because she gets paid more as more money comes into her funds. So really hyping up those investments helps her as she gets to collect more management fees. If you're trying to calculate your own alpha or risk-adjusted returns to see if you're underperforming, outperforming, you can take this formula where it's the portfolio return minus the risk-free rate. So you can use something like a 10-year treasury bond yield and subtract that from your return. And then to calculate the beta, you would take the weighted average beta of your portfolio. So let's say 50% of your portfolio is in a stock with a beta of 2, and the other 50% is the S&P 500, and it has a beta of 1. If you do the math, your beta is going to be 1.5. And then you take that number and multiply it by the market return minus the same risk-free rate you had over here to come up with how much alpha you generated. Main takeaway of the entire video is to always think about the risk that you're taking with any investment, whether it's an ETF or an individual company. The beta, the volatility, and risk of that purchase should be factored in when you're looking at the returns over a long period of time. If you guys did enjoy the video, make sure to hit that like button as well as consider subscribing to Main Street Wolf, where we talk investing, stocks, anything to do with money. Thanks guys for watching, and have a great day.